The Money Show.
Personal Finance with Warren Ingram.
This personal finance feature brought to you by Toyota Financial Services. Toyota Financial Services is an authorised FSP and registered credit provider. T's and C's apply. Warren Ingram, director at Galileo Capital and also personal financial advisor. Let's talk about the economy and the fact that it is not, let's say it, a live wire economy, and why it is that the stock market is as strong as it is, because people, I think, really struggle to come to terms with this idea that just because the economy is weak doesn't mean that the stock market is weak as well. And it's a really important conversation to have.
We can tell it's December because you're bringing out the dad jokes, Bruce.
I missed. You know what's more tragic than anything else is whatever dad joke was contained in that introduction, I missed it myself. I usually do them deliberately, but it's becoming instinctive.
Is Livewire not a reference to Eskom? So
sadly, I'm not. I am bright. I am sparky, but not that bright and sparky. That was on purpose. Right.
So let's talk about two things with respect to the economy and the stock market. The first is just an absolutely general principle with all economies and how they relate to their own stock market. So in any country where you've got a stock market, always important to understand that the economy is telling, when you get economic data, we hear that, we hear these numbers being quoted, the GDP was up or down, or unemployment was better or worse, or whatever the number is that's being quoted to us. We're being told about recent history. We're not being told about the future. We're being told about what's already happened. And a lot of the time, the data can be quite old. It's not, in especially countries like ours where data is not necessarily tracked live and in real time. It needs to be collated, checked, verified, sterilized, and then published. And so what we might hear about, could have happened 2 or 3 or 4 months ago already. And so it becomes newsworthy because it is telling us what has happened to our bread and butter as South Africans, but it is old information. The stock market is a very different beast altogether, because the stock market generally is populated by investors who are looking to the future. They're looking. Some of them are only looking 3 minutes ahead, and unfortunately, those are the ones that have a very tough time. But other investors are looking a few days and a few months and potentially a few years ahead. And so when a stock market is a forward-looking thing, it can often start to deliver surprisingly good returns and surprisingly good growth right in the middle of really bad economic data, because often what happens is you kind of hit the bottom of a recession in an economy where the economy's gone backwards at a massive rate, and you hear about horrible unemployment and all of these things. But what happens is we start to see the first shoots of new green grass, or spring coming from an economic point of view, and the stock market gets really excited about that, and suddenly you start to see a big jump in share prices because investors are starting to get really excited about future prospects. So it's to say, we've hit the ground, we've hit the bottom of the hole, and next month will be better than this month, and so the optimism kicks in and share prices rise, and that's a generic thing for all stock markets, and ours is absolutely no different. So while we're sitting in the middle of horrific load shedding, and the spokesperson for Eskom telling us it's going to be like this for 6 to 12 months. There are investors looking at this and saying, well, we've come through a heck of a lot already, and there are companies out there that are, survival of the fittest are doing relatively well. So that's one reason why our market is reasonably strong. But the other one is probably much more relevant right now, and that's to understand our stock market is not really a price of our economy. It's not really a price of the South African economy specifically.
This is the most crucial thing that you're going to tell us this evening, Warren, and this is what you need to explain in more detail, please, because what is it? 75% of the value of the shares on the JSE is made up by companies that make most of their money outside of South Africa. Probably higher than that now.
Yeah, I mean, I just looked at the top 10, and out of the top 10, 5 of the top 10 earn most of their money out of the economy in South Africa, and in fact, those 5 companies account for 40% of the value of the the top 40 index. So just to explain that, so you've got just to name them, so you've got companies like Richmond, Anglo American, Naspers, British American Tobacco, and Process. Those together account for more than 40% of the value of the top 40 index. So, for every 100 Rand you've got invested in the top 40, 40 Rand of that is just in those 5 companies alone. And those companies earn the vast majority of their money outside of South Africa, whether they're selling, cigarettes or jewelry or Chinese tech and the like, they earn a heck of a lot of their money out of the country. And that's just the big 5 out of the top 10 shares. When you go further and further down, even if you go to the babies, some of the smaller companies like Invicta and Bell Equipment, they earn probably close to 40 or 50% of their revenue out of South Africa. So it's not unique to the big businesses on the JSE. It's right the way across the market. And so when you get despondent about the economy in South Africa and bleak about our prospects, and there are reasons to be really concerned, it's important to understand that the value of the JSE is more linked to what the world is doing, and especially what potentially what global emerging markets are doing. And I think that's the key to understand. Our stock market is quite divorced from the prospects of our economy. There are some big shares on the JSE which relate to the economy here, particularly the financial services and let's say some of the telecoms businesses. But the balance, they're pretty much global emerging market businesses. And so when the world starts to become a little bit more optimistic about the end of inflation, in the developed world, and as the Chinese government, progress with their unlocking from their kind of COVID zero policies, sentiment will pick up, and that will be very positive for a lot of the companies on the JSE. So you could find a situation where we're at stage 6 or 7 load shedding and really negative prospects in South Africa, but the JSE just doing incredibly well, and especially if demand for commodities and our resources pick up as well, because that's the other tailwind that we're facing. So it is really important, Bruce, that people don't get so fixated on the economy and then say, well, the JSE falls over. The two could move in very different directions for multiples of months, if not years.
And the weird thing, because of the structure of the JSE and because so many of the profits of the companies that are listed on the JSE come from outside of the country, the perverse thing is if the economy does break and we do see a currency meltdown, at least in theory, we should see the valuation of shares on the JSE rocket quite substantially as a result of a weakening currency. We saw that happen to resources shares last week, for example, as the Rand lost value in the face of the possibility of the president's resignation following the Section 89 report into alleged corruption related to Phala and whether he breached the constitution or not. And then we've seen a subsequent reversal in the currency and a return to normal as the president has stood firm. And the resources shares have responded, in line with that. You've seen those resources shares firstly gain huge value and in some cases lose some of that value as stability has returned.
Exactly right, and I think in addition to that, as a kind of a little bit of optimism is filtering into global markets, that will feed through to companies like Process and Naspers and Richmond as well. So you could find we get a huge currency benefit for those companies if the Rand does weaken. The only trick there is that Rand weakness must be specific only to South Africa. If it applies to kind of the world. Then we're back in just tough times again. But I think it's amazing, just talking to people, they become so despondent about our economy, and not I think it's a rational view. I'm not certainly not condemning the view, but gee, linking that to the JSE from my perspective is just such a mistake. The JSE, I think if you look at the valuation of the JSE, it's offering incredible value. And just to understand, because these companies operate in so many markets so far away from South Africa, don't just throw that JSE out as a potential investment index. And I know a lot of people keep saying, sell all the shares on the JSE and send all your money overseas. But that's understanding then that you're selling Richmond and Naspers and British American Tobacco and the like, and probably buying very similar businesses overseas, but potentially potentially at much higher prices. And that's a mistake investors shouldn't be making at this moment in time.
Question from Mart this evening. Mart's got a wonderful problem. It's a capital gains problem. It's a tax problem. And that tax problem comes from being disciplined and making lots of investments. He says, I'm very happy to say my investment journey is well on its way. With investments accumulating in my personal name, I'm now worried about estate duty and other costs. Would you recommend investigating structures like companies, trusts to help mitigate this? Such an important question, because you've got to be looking at mitigating your tax obligations in every legal way possible, because you're entitled to do so. You must pay all tax that, of course, is due. Does it help at all to structure your affairs in a more adventurous fashion? Perfectly legally, of course. That's the question to Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So, Warren, how to structure affairs in a way that is entirely legal to mitigate the impact on your personal estate when inevitably you will die one day. It's a terrible realization. I'm so sorry to break it to everybody. But you are going to die one day. And when you do, is it better to leave your assets where and how?
It's such a key question that a lot of people face as they start to build up, an element of wealth and an element of capital, and it usually starts with some tax advisor saying, when you die, you're going to pay, estate duty, or your estate's going to pay estate duty, and your kids and other beneficiaries are going to lose out on some money. And then you kind of naively get taken down this rabbit hole of estate planning and structuring, and usually the conversation starts with you should seriously look at a family trust, and this family trust should then own a holding company, and potentially separately the family trust should also own an investment company, and then you build up all your future wealth in those things, and then your estate is protected from estate duty in the future. And fantastic estate planning has been done, and congratulations to you, and your beneficiaries, and there is scope for that kind of estate planning. I mean, I would hate for someone to think that there isn't benefit. However, those structures are enormously expensive, and also to understand that SARS really doesn't like trusts at the best of times, and has done its very best to make sure that the tax that trusts will pay is much higher than anything we pay in our own names, for all time, whether it's income tax or capital gains tax or in any of those taxes. So it's a really important point that, when you start accumulating money, don't just listen to the tax advisor to save tax, because what might actually be happening is you end up destroying wealth because you're paying so much in the fixed costs of all of these structures that you've got, and actually lots of tax along the way. So you end up saving a little bit of estate duty at the end of your life, but giving away huge amounts of growth and costs all the way along. So for me, I'm certainly not claiming to be a trust expert, but I would say, the only time I'm really going to look at a trust seriously is, if I've got assets that are worth at least about 7.5 million rand after all debts, et cetera, and probably only really about 10 or 12 million rand to start justifying the costs of a trust. And if someone tries to sell me an investment company as well inside a trust, you're looking at 15 or 20 million rands worth of investment assets. And I think that's a key point here, is just understand, these structures have a huge cost, and that those costs aren't always just upfront. They multiply over many, many years. And I always think the much easier ways, Bruce, to save estate duty. I mean, one thing people don't think about is your retirement fund, whether it's an RA or a provident fund or living annuity. All of those things, they don't attract a cent of estate duty. You can leave those to your beneficiaries without a cent of tax being paid on your death. And if your beneficiaries keep those RAs as they are and decide not to draw on them for some time, they're deferring a huge amount of tax for many years. So that's one very simple way. And I guess another obvious one is the tax-free savings account. So and then looking at international investments, every man and his dog is sold an overseas trust as a concept the moment they start putting money overseas. And I think those costs are even higher for overseas trusts. So generally, a rule of thumb there is around $1 million of investments before the trust starts becoming viable. No, huge amounts of money involved.
No, absolutely. And I'm delighted that you put numbers to it here, Warren, as well. Because, Mart, I don't know how many assets you have. And if you are being diligent and you're going to get the power of compounding over time. I mean, should you be, if you are diligent and you can and you say, you know what, I am, maybe Mart is, say, 35. If Mart is going to keep investing and is going to be religious about it and very good about it, can project that in, 10, 15 years' time, he may very well have a sizable amount of money, whether it be 10 or 15 million rand, the sort of numbers you're talking about. Do you start putting all of those things into those structures now because you know that you are self-disciplined, you know that you're going to need to have those protections, for want of a better word, at some point in the future? Yes, you pay lots of cost now, but surely to convert those from your own name into a trust structure at some point in the future will draw lots of costs in its own right.
They would attract some costs, but I think that let's just say you accumulate all the money in your own name, early days, and you get to that sort of 10 million rand mark, and then you decide to invest the money in a trust at that point. The one thing there is you're dealing with a certainty. You know you've got the capital now, as opposed to a plan or a projection or a hope. And secondly, you've got the capital available then to pay whatever those costs are and restart the capital growth inside the trust in future. But more importantly, the next year, the first year of that trust's life, the growth that you're getting should be sufficient to pay for the running costs of that trust without all of the growth plus more being eaten up simply just by trying to feed the beast of the costs of the trust and potentially trustees and other companies, etc. And I think what happens then is, if you do a projection where you say, well, I should get to 15 million rand in 10 years' time, you've got to include really significant running costs in that projection, and then maybe it takes you another 3 or 4 years of growth before you get there. And I just don't like that, because you're relying on so many variables to get you to that point that I'm just not comfortable making that call. And I think also, life changes a lot over a 10 or 15 year period. If you have money in a trust now in South Africa, just understand your trust can't invest overseas. So you're limited then to either buying rand denominated overseas investments and the like. I think you're taking away a lot of flexibility is my short answer.
Thank you, Warren Ingram. At Galileo Capital, we'll wrap up the year with Warren next Thursday on the Final Money Show of 2022.